When a massive corporate entity grows too heavy to sustain itself, the pressure eventually forces it to fracture. Right now, we are watching that exact process play out in real time with one of the biggest names in the market. Vedanta, a 3 lakh crore conglomerate, is carving up its empire. They are undergoing a sprawling demerger to break their distinct businesses apart. This flowchart maps out exactly where the pieces are landing. The parent company is splitting into 5 distinct entities. You have the core Vedanta holding the zinc operations, then VAML taking over aluminum, TSPL absorbing the power sector, MEL handling energy, and finally VISL managing iron and steel. The company has announced a straight 1-to-1 ratio. If you hold 1 share of the parent Vedanta stock on the record date, you will receive exactly 1 share in every single one of those 5 new companies. On paper, getting 5 stocks for the price of 1 sounds like an instant wealth multiplier. But the underlying math doesn't create spontaneous value. A $400 stock doesn't birth 5 new $400 stocks. That original total market cap is simply sliced 5 ways. The demerger is an administrative division of the exact assets you already own. It reshuffles the deck. It doesn't add more money to the table. The real complication is the timeline. This split was originally targeted for last year. Now, the company has officially pushed the completion date all the way back to June 2026. The official explanation for the delay points to unresolved regulatory issues and a lack of necessary government clearances to finalize the paperwork. For anyone buying in today, your capital is locked in a massive transition phase for over a year and a half, heavily exposed to the broad market's movements while you wait. That forces a difficult choice. You have to decide if tying up your money until 2026 for a post-split market surge is a calculated strategic play or a dangerous trap. Navigating an 18-month delay requires ignoring the hype around free shares and taking a hard look at the actual corporate risk sitting inside the parent company right now. If you only check the surface-level metrics, Vedanta looks incredibly tempting. At current prices, it's trading at a price-to-earnings ratio of 26.5, which is cheaper than the industry average of 36.9. Add in a 38.5% return on equity, and it looks like a textbook buy. But this health scorecard reveals a glaring problem. Behind strong returns sits a dangerous debt-to-equity ratio of 2.12. This introduces the riskiest component of the demerger, debt allocation. You cannot split assets without splitting liabilities. That immense leverage must be carved up across the subsidiaries. Management has a few ways to handle this. In an equal distribution scenario, they spread the pain evenly, and all 5 new companies take on a proportional share of that systemic risk. Then there is the toxic spin-off scenario. This happens if the parent company decides to dump the vast majority of the debt onto 1 or 2 specific sectors, effectively crippling them from their very first day of trading. The flip side to that is the golden spin-off. If the toxic debt gets isolated, certain sectors, like zinc or aluminum, could escape almost entirely debt-free, turning them into highly lucrative, clean assets overnight. The demerger is essentially a high-stakes liability transfer event. The long-term survival and valuation of these spin-offs depend entirely on how that debt is distributed. This chart tracks Vedanta's core sales, exposing severe volatility. In December 2024 and September 2025, sales plummeted 50% to 7,000 crore rupees. Yet profit rarely moves. Sudden injections of other income artificially smooth the balance sheet to maintain a steady 4,000 crore rupee profit. Relying on non-operating income to rescue your profit margins makes a company fragile. It weakens the foundation required to sustain their massive dividend payouts over a multi-year horizon. Once the split actually happens, the market mechanics take over. Breaking the company into 5 means the absolute share price of each new entity will drop significantly. We are likely looking at stock prices in the $100 to $150 range. Historically, low triple-digit stock prices act like a magnet for retail investors. The optical illusion of a cheap stock triggers massive buying frenzies. When that heavy volume floods into these newly listed, lower-priced stocks, it causes extreme short-term volatility and violent, sudden price spikes. These surges reflect market momentum and retail psychology. They occur independently of any change in the company's core financial health or its underlying debt load. We can see exactly how the big players are digesting this wait time. Over the last 2 quarters, foreign institutional investors have steadily increased their positions in the stock. On the opposite side of the trade, domestic institutional investors and public retail holdings have actively decreased. Local money is moving out. FIIs are positioning for long-term sector cycles, while local retail investors are exiting to avoid the 18-month opportunity cost. This decision tree maps out 3 distinct paths depending on your timeline. Let's start with the top path, the prospective FOMO buyer looking to jump in right now for those 5 new shares. The flaw in that strategy is severe. Buying in today means you are absorbing a 2.12 debt-to-equity risk without knowing the final rules of the split, all while locking up your cash for an 18-month wait. If you are a prospective retail buyer on the fence, the verdict is simple. Avoid the pre-demerger hype entirely. The risk of the unknown outweighs the reward of early entry. For the second group, the current shareholders who already own the stock, your capital is already committed. Your playbook is to hold through the June 2026 record date to secure your 5 allocations. But your real work begins the moment the company files the official debt distribution paperwork. You need to read those filings closely. Be prepared to ruthlessly sell off whichever spinoffs get saddled with the toxic debt, while safely holding on to the clean, high-performing sectors like zinc or aluminum. That brings us to the third group, the post-split sniper. The optimal value strategy is absolute patience. You wait entirely until after the 2026 split is finalized, the debt is distributed, and the stocks are trading independently. Once the dust settles, you can treat the market like a conveyor belt. You evaluate the balance sheets, you bypass the rusted, debt-heavy companies, and precisely target a single clean asset. You trade away the chance at a pre-split price run-up. In exchange, you eliminate the blind risk of inheriting Vedanta toxic leverage. Navigating this split requires surviving the 18-month timeline and executing surgical asset selection once the liabilities are finally assigned.